Many people will say the current economy is strong, but there's a growing number of others that would disagree. The economy is weak, we may even be in a hidden recession. Bottom line, we are struggling. And both sides are right, because the metrics we use to gauge the economy are sending us mixed signals. Over this first half of the year, the overall consensus is the economy is strong from a national point of view. The things that support this are inflation slowdown, the job market, the stock market, and as of recently, consumer confidence. But these economic indicators aren't the full picture. They don't tell the whole story of what individuals like you and I may be facing on a daily basis. So even though inflation is trending down and the stock market is touching all-time highs, you and I could still be experiencing financial hardship. Let's start with inflation, because I think a lot of people are wondering why prices are still high despite being told inflation is getting better. The CPI data for April came in at 3.4% year over year for all items, and core inflation sat at 3.6%. This was a slight improvement compared to March, but not by much. The short-term trend looks like inflation has stagnated above the Fed's 2% target. So although inflation isn't nearly as intense as it was 2 years ago, the inflation rate is still positive, meaning prices are more expensive today than they were 2 years ago, even though the inflation rate was much higher back then. Unless the rate of inflation turns negative, overall prices will continue to go up and up. It doesn't matter if that rate is fast or slow. A real-world example of this is the price of fast food, like McDonald's. In a study conducted by Finance Buzz, it was found that McDonald's prices increased 100% over the last decade, outpacing inflation by nearly 70 percentage points. A Big Mac, $6 now. A quarter pounder with cheese meal, $11.99. And one of my personal favorites, the McDouble, $3.19, an increase of 168%. And when people started asking McDonald's why their prices were jacked up so high, they cited the increasing cost of labor as a main contributor. Their employees make more, so they have to charge more for food. Let's assume that's true, and they didn't use inflation as a profit opportunity. This highlights the dangers of inflation and the feedback loop that it introduces to the economy. Their employees face higher prices in their lives. They require higher wages. McDonald's raises prices, which means employees face even higher prices as consumers, and so on and so on. Higher prices become entrenched or permanent in everything else, just like they did at McDonald's. And that is why it feels like inflation is still a problem. We went through rapid price increases in 2022 and then have gone through a period where those higher prices became the standard. If inflation has been a serious issue for you or your family, you're definitely not alone. 41% of surveyed families list inflation as the most important financial problem, and it wasn't even close. The next two were the cost of shelter and debt at 14 and 8% respectively. And speaking of those two, let's talk about those next. Because the Fed raised interest rates to combat inflation, any purchases that would normally involve financing are flat out unaffordable. You and I are being squeezed at both ends. Not only are prices persistently high, but the interest rates on the financing are also high. Couple those together, and most people just can't make the purchase work. The average 30-year fixed-rate mortgage is lent out at about 7%. The average new car loan rate for prime borrowers is also 7%. Consider that the average home price in Q1 of this year was roughly $420,000, and the average new car price is about $47K, and it's not hard to see why the average mortgage payment is $2,200 and the average car payment is $738. Inflation measures like CPI leave out a key component to the financial pressures of everyday people, and that's the cost of financing big-ticket items. home and car prices skyrocketed over the last year. That's clear. But throw on top the cost of borrowing, and the situation looks astronomically worse. Now, as far as consumer debt, which I think could be the most important indicator that the economy is more fragile than it seems, is sitting at ridiculous numbers. As of last quarter, total household debt reached $17.7 trillion. $12.8 trillion was related to housing, and the remainder was attributable to things like auto loans and credit cards, which, by the way, both exceeded $1 trillion. Those credit card numbers come out to an average credit card debt of about $8,000 per household, which may seem like a manageable amount relative to the size of mortgages or auto loans, but you have to consider the credit card's interest rate. 20% plus is common, and I do not say this lightly. 20% interest rates on debt are enough to snowball quickly and quite literally financially destroy you. So it's worth mentioning the uptick in credit card delinquencies, a sharp increase represented by an additional 2% of all credit card balances reaching 10%. My point is this: if the economy is continuing to operate at such strong levels because consumers continue to buy goods and services at these elevated prices, but the way they're affording to do so is through high interest rate consumer debt and not their wages, well, then the economy is susceptible to an abrupt pivot. There's a tipping point where the fact that the majority of Americans are living paycheck to paycheck, coupled with an unaffordable environment, and then adding the fuel of high interest consumer debt, that all of this stops in its tracks. Because debt stimulated growth just isn't sustainable. All of this was to say that if you're struggling financially, if you can't afford a house or a car, if you can't keep up with higher food costs, if you're relying on credit cards to get by, you are not alone. And it might be frustrating to turn on the news or read an article and hear that the economy is strong. Hell, I've even made videos in the past on why it's good based on the usual metrics. But your individual experience is all that matters in your perception of where the economy stands today. And your perception is valid. Period. All right, y'all, if you enjoyed the video, consider giving it a like and subscribing for more. If you have any questions, drop them in the comments or feel free to email me at askalexherrera@gmail.com. As always, thanks for watching. Until next time, take care of yourself and best of luck.